Welcome to Market Matters. I'm Nadia Hassan together with Khoo Chuang.
Greetings.
Yeah, the thing is why we're a bit perky is because it's almost the end of the year.
2 days to go.
Exactly, and we're trying to wrap up to see what actually happened. So as a result of that, when we talk about companies in the news, there weren't many people in the news, but this one was. Heng Huat up about 3.4% to 61.5 cent. In fact, in its rapture, it actually almost reached 64 cent. But this is still a far cry from the highs it saw in November, because in November it reached a staggering sort of 87.5 cent. It's not even been a month. That is a fall from grace.
Well, yeah, exactly. So basically, Hong Leong Bank reckons this is a trading stock because having reached the heady heights of 88 cent on November 25th, it's now come down to about 61 cent for today at the start. That's a 45% plunge for a company which had a 92.3% increase in net profit for the third quarter. This is a biomass company. They also do mattresses. Their biggest market is China. So maybe Hong Leong is postulating that the Chinese whole slowdown, yuan devaluation issue is hurting the Chinese the market, blah 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 blah.
Yeah.
But the profits are intact. So there's half a story here.
Yeah, I kind of agree with that, because in their notes to announcement, they did actually mention that they do see revenue down on the top line due to that lower sales of those fibers that they manufacture in China. But at the same time, the fact is, like you say, your bottom line's up, so you must be protecting your margins somewhere. Maybe they're just being on the cautious side of it. Let's not forget, right? They actually have the lion's share of the domestic market.
Of the local market.
Exactly, 40% of the biomass materials all come from them, because if you look at the lowdown that they have, they actually do it from, like we say, palm oil fibers, which of course we have no shortage of, and coconut fibers as well. That's what they use to stuff their mattresses. So the thing is, right, I do see some positivity for them, but I think the China story is eternally going to be a thorn in their side. It's a blessing and a boon. When she's a beautiful mistress, she's a beautiful mistress. But sometimes if you look too close, her teeth falls out.
Unless you sweat the small stuff and you look upon the day-to-day volatilities. But the Chinese market is the Chinese market. It's a 1.4 billion market. It's going to be the Chinese century, as they say. So if you're really, really long on the Chinese market, then you're long on Heng Huat. But I saw the volume and the interest in the shares today. It didn't really have any strength behind the rally. If you come down from 81 cent, or 88 cent, you want to snap back. There's usually some backing behind it, but there wasn't really.
Well, they actually did have a story today on the edge markets, but I think it wasn't really much in terms of persuasion. But talking about China again and looking at you're talking about long, right? One of the things that I found interesting when I was doing the research for this was the fact that they are banning new coal-fired plants in Beijing because they had to issue a national alert because the smog in Beijing was so dangerous, just as bad as the haze here.
As well as in Shanghai and Gongchao.
Exactly. So because of that, they may have to switch, as they say, until cleaner sources of energy. Let's see if they stick.
Like the briquettes that Heng Huat does.
Exactly. But will they stick to this promise? I'm not really sure. But anyway, just to bring it all home for you, we're looking at Heng Huat. They actually went up about 3.4% today to 2 cent to 61.5 cent. But of course, this is nowhere near the dizzying heights it saw in November, where it was pretty much almost like 88 cent. So this company does biomass. Their earnings are still intact, but people are still worried about whether or not there's any strength behind the trading for them. Moving on finally to our broker's call today, we're looking at one of my favorite shopping mall owner portfolio, guys. I like Pavilion. I have to admit,
That's like Desmond Lim's place.
Yes, exactly.
He of Bandar One Malaysia aspirational fame. He wants to buy that block, 486 acres in Bandar One Malaysia.
Have you heard some of his interviews when he talks about this? He makes it sound like he wants to change all of that part of downtown to Pavilion into some kind of rodeo drive.
Well, why not, right? Then he'll have to compete with YTL's Francis Yeo because he reckons he's got his own radio drive there.
Well, actually, that would be really funny. Put them in a cage match and see who wins.
Yeah, put a horse there and a rodeo there.
So the fact is that we're looking at Pavilion REIT because today we have two analyst houses looking at it. Kenanga outperformed with a higher target price of 168. MITF is neutral on the stock with an unchanged target price of 153. The stock itself closed 0.7% to up to 1 ringgit and 54. REITs in general don't really move
so
much.
The news is that they bought the Intermark for 160 million ringgit cash. They're going to pay, basically that leaves their gearings at Pavilion REIT level at just 0.5 times gearing. When I saw the data behind Pavilion, behind the Intermark, I think the assumption is about 7 ringgit 20 cent per square foot rental. That's not too bad, especially when you consider the other smart buildings around. But get this, right? Just 74% occupancy rate. That's not too good for something which is so central.
Yeah, exactly. That's because I think we are having this issue now where the glut of commercial spaces, especially in downtown KL, if you've actually been away for a year and you come back, you will not recognize half the buildings that seem to have popped up. So I think that's a lot of pressure on it. But Kenanga does seem to think that now that Pavilion REITs actually bought it in, they can drag up the occupancy to 80%. I've been to the building. It's really pretty. It's
nice, yeah.
It's really nice. But it's an office building. It's not something I fall in love with or something I want to go visit unless I want to go Red Lobster.
Well, for me, the kicker for this deal, and it's not a bad deal, 160 million ringgit, because when you look at it, it comes packaged with a profit guarantee, okay? Over 3 years, 15.4 million ringgit per year. That's not too bad, especially when you consider in 3 years' time, KL might well be in the depths and throes of the commercial office supply glut, oversupply situation.
Do you think in 2 years it's going to be that?
I think so.
But who will be the biggest impact, you think, when we see this kind of oversupply situation?
You've got Bandar Malaysia, you've got all the buildings happening around there, the whole central business district, there's all the whole conurbation that's coming out into the PJ, Bangsa area. You've got swaths of PJ all building office commercial space. So,
We'll have to see how
there's going to be a lot of space in the market.
Well, we'll come back in 2 years and see whether or not your prediction actually comes back to be true. But moving just to what is in the store for the guys who are in Pavilion REIT, Kenanga does think that management might look to acquire Fahrenheit 88, yet another building which I think doesn't have great occupancy rates. If you're not KLCC or One Utama or Mid Valley, it's hard to see any other shopping mall aside from something like the Curve, which we're nearby, which is fairly decent because it's positioned itself as like a neighborhood mall. I'm not sure if that is going to just sort of add for them, but they do. But Kenanga does seem to think that 2016 earnings will actually be good for them. MIDF, as we mentioned, massively neutral on this. They think, in fact, I was reading the report and they seem to think it's just meh, and they're maintaining all their estimates.
Yeah, because they're neutral, because they reckon that the upward rental revisions will be marginal because consumer sentiment is weak. People don't really want to go shopping when GST is in full play. And, Nielsen have said that Malaysian consumer sentiment is the lowest in at least 10 years.
I will agree with you and disagree with you because you've not seen the jams around Mid-Valley. I don't know what those people are buying.
There's still people that work there, though.
No. This is on weekends.
Yeah, I guess. But on a nationwide basis, a lot of people are just very smeh on the economy.
Okay, so just on that really down note, we hate to leave you that we're looking at Pavilion REIT for today's broker's call. Basically, the Kenanga, what happened is they actually bought the Intermark. Kenanga seems to think it's actually quite a decent deal at a good price, outperformed with a higher target price of 168. MIDF is all meh. They say we're keeping neutral with the unchanged target price of 1 ringgit and 53. With that, that's all for Market Matters today. I'm Nadia Hassan together with Khoo Chuang. Join us tomorrow for our last show of 2015.
How time flies when you're having fun.
Exactly. If you want more on all the news, look at theedgemarkets.com or pick up a copy of the physical paper. Good night, guys.